Well, it's no secret that we've started off 2022 with some pretty extreme market volatility. At this point, with the continuing bad news affecting the markets, with everything from the Federal Reserve rate hikes, the Russian invasion of Ukraine, and supply chain issues regarding COVID-19 shutdowns, you may be feeling helpless and things are just out of your control. The old adage of stay the course, don't panic, the markets will rebound. Although true, and has always been true, it doesn't feel good when that helpless feeling overcomes us. So we're going to look at this a slightly different way. Although I've been through numerous market declines in my career, some of you, either new to investing or maybe recently retired, are noticing this and possibly experiencing this for the first time. As human beings, we like to be in control. When we feel things are out of control, it causes stress and anxiety. So we're going to look at this a little bit differently. We're going to look at this proactively, and I've come up with 5 highly effective strategies to consider in a down market. So let's go to the whiteboard. Okay, guys. Let's look at 5 highly effective strategies on our whiteboard today. Slight disclaimer here, please don't try to run out and do these strategies on your own without consulting your financial advisor or your tax advisor. A lot of these strategies are connected with other parts of an overall plan and can throw some things off on other plans. So it needs to be looked at holistically in the concept of an overall plan. But some of these strategies are things that I think you should consider in a down market. And let's face it, the first 4 months of 2022 have been pretty volatile, and we are currently experiencing a down market almost across all asset classes. So let's go ahead and take a look at strategy number 1. Strategy number 1 is Roth conversions. And what we're going to do is we're going to talk about how this can be beneficial from a tax standpoint in a down market. So let's just draw 2 buckets here. We'll draw a traditional IRA bucket, and a traditional IRA is tax deferred, taxed later. One day those assets will be taxed. Right now, current law is age 72 is the required minimum distribution. If you're over 59 and a half, of course you can withdraw money out of your IRA with no penalty, but it is taxable. And then we're going to draw a Roth IRA bucket. So a Roth is tax-free. Couple misconceptions about this. If you don't already have a Roth, you can open up a Roth IRA. You don't need to be working to open up a Roth IRA. You do, however, need to have earned income to put new money into a Roth, contribute to a Roth. You need to have earned income, and there are limits to pay attention to. But what if you're not working? Can you still open up a Roth? Of course you can. And with that Roth not having any assets in it currently, in that example, you can do a conversion from a traditional IRA. Converting money is not the same as contributing money, contributions. Just don't get those 2 phrases confused. You can always do a Roth conversion. There's no income limitation, and you don't have to be working. So, interesting strategy. Now, how does that help you in a down market? Let's take an example. Let's say you own XYZ stock, okay? And we're going to keep this really, really simple, guys. I know you have diversified in portfolios. You're not all in one stock. But I'm going to use this as an example just to demonstrate the power of Roth conversions in a down market. So XYZ stock, and we're going to say that you own 1,000 shares at $100 a share. So $100 per share of XYZ, and you own 1,000 shares. So your account value in this traditional IRA is $100,000. Okay, very, very simple. If you converted that $100,000 right now, and let's back up and say this was as of January 1st of this year. So we'll say this was January 1st of 2022, and you have $100,000 in that account. If you had converted it at the beginning of the year, that $100,000 would show up on your tax return as taxable income, and you would have to pay taxes on that $100,000. It could even possibly push you into a higher tax bracket. So now let's say here we are, April 29th, 2022, and XYZ is now only worth $50 a share. There was a 50% drop in value on that stock. Now, that may sound radical, but there are some stocks, Netflix is one, for example, that's down more than 50% since the beginning of the year. So again, just as a simple explanation, there's a 50% drop. So you still own the same 1,000 shares. So now your account value is only worth $50,000 instead of $100,000. Now, people often don't realize that you can convert shares rather than just cash. So you don't have to sell the shares in the traditional IRA and then move the cash over. You could do it that way, but you don't have to. Let's say you have faith in this company, faith in this portfolio, that markets rebound, and oftentimes markets do rebound. As a matter of fact, they've never not rebounded and go on to make new highs if you follow the rules and you stay disciplined. But let's just say that you have extreme faith that this company is solid. It just got caught up in everything that's going on so far this year, and it is going to rebound. So you transfer the shares to the Roth. So you never touch the money. It goes from one custodian, typically one account to the other at the same custodian, and that 1,000 shares now goes into the Roth. So you essentially converted $50,000 into the Roth. Well, now that $50,000 shows up on your tax return as taxable income, not $100,000 as if you had done it in the previous year. Now, it's in there, right? It's at $50 a share, and now it's in the Roth, and let's say it rebounds. Let's say by the end of the year, it made everything that it lost, and now that same 1,000 shares is back up to $100 a share. So now you have a $100,000 in this Roth IRA where $50,000 of it was basis and the other $50,000 is gains. The $50,000 of gains is tax-free for a qualified distribution. So just keep in mind there is a 5-year rule on any gains in a Roth cannot be distributed for 5 years. But after that 5-year period, all those gains and your original $50,000, because you pay taxes on it, is now tax-free. So a great strategy to consider transferring shares to a Roth IRA as a conversion in a down market. All right, let's go to strategy number 2. Strategy number 2 is possibly, if at all possible, and you are withdrawing money out of your portfolio in a down market, can you limit those withdrawals? Do you have access to other funds while the market is down to limit those withdrawals? So this is one of the areas where we talk. Now, this isn't always possible, by the way. You need the money to live on. That's what it is. But let me show you the power of this strategy just to consider. And we talk about tax diversification as an important piece of this, and understanding where your money is allocated between principal not guaranteed assets, market assets in the market fluctuating, and principal guaranteed assets. So real quick, if you look at this screen on our whiteboard, the red says non-principal guaranteed. Now many of you guys know that I'm not a believer in variable annuities. Don't like those products. I don't like cash value, variable life insurance. So let's take those off the board. So many of you have 401ks, IRAs, 403bs, brokerage accounts that are in these categories: stocks, bonds, mutual funds, REITs, maybe some commodities and options as alternative investments. We don't really see that too often. But you have money in this non-principal guaranteed area, and that's the area that's fluctuating, and you may be withdrawing those assets while the market is down. And yes, maybe you have an emergency fund. By the way, 6 to 12 months is very prudent in an emergency fund, having those assets in something safe. It might be a bank savings account. We know you don't make much in that situation, but it could be an area where you could withdraw and supplement your existing income while the market is down, letting those assets hopefully rebound in the future and supplementing your income with money that has not fluctuated. So that is essentially what an emergency fund is. So we highly recommend having 6 to 12 months of expenses in some type of safe savings account, money market account, something that is not subject to volatility. The other thing I want to tell you about is fixed index annuities. This is an area that I think some folks can consider as part of their overall plan. Now, a fixed index annuity does participate in market growth, but your assets aren't actually in the market. The insurance company is just using an index to track how much interest they are going to pay you. Most common index is the S&P 500. So when the S&P 500 increases, you get some gains. You share in the gains, not all the gains. When the market decreases, the insurance company is providing a protection there and says your account value does not go down. So you're trading off some potential growth. You're trading that off for some safety. But this is an area that you can consider. Maybe you have a fixed annuity, and you can consider maybe looking at a withdrawal from that account because that asset is protected. It's not dropping in value. Rather than pulling it out of a brokerage account or an IRA or a 401k account. So it's an area where you can look at, hey, maybe I have a free withdrawal available. Maybe I can start my income slightly earlier than I thought I was originally going to start it, and that's going to supplement my withdrawals while the market is extremely volatile. So an interesting area to think of. Keep that in mind. And then with that being said, let's just give you an idea of what sequence of returns risk really is and what that looks like. This is all kind of related in the same subject here. If we look at two portfolios, and this is something to consider entering in retirement, and we look at portfolio 1 here and portfolio 2. The thing I want to point out about this, you'll see these tables and these charts, and we'll just go from 2000 to 2015 to make this example very, very simple. Portfolio 1 has an average return of 5.67%. Portfolio 2 has an average return of 5.66%. Okay, basically identical average returns. And we're going to say that the portfolios start with $1 million in each portfolio. Okay? And then portfolio 1, you're going to have starting out 3 negative years. Again, can't predict whether the market's going to go up or down. In this example, you're going to start out in negative years. And the other thing I want to point out is you're withdrawing $50,000 a year out of the portfolio. Well, withdrawing money out of a portfolio in a down market and starting off with 3 negative years, it can be difficult to recover those assets because you've sold assets. They're no longer in the market sitting there in shares to recover. So what's interesting about this, we end up having, after 15 years, $363,580 in this portfolio with a $50,000 withdrawal each year. Contrast, portfolio number 2 didn't start out with a negative year. It had a positive year the first year. Then there was a negative year followed by some positive years. Same exact average rate of return, same $50,000 withdrawal, but look at the difference in the final, after 15 years, the account value at the end of 15 years, $1.1 million. So this is what we call sequence of return risk. And again, this is unpredictable. So what can you do to mitigate against this? You can have assets in other areas, your emergency fund, possibly a fixed index annuity, other areas where you can pull some withdrawals from if the market is going down. And that brings us to strategy number 3, kind of really along those same lines is, what if you've been thinking about starting Social Security, but you just haven't pulled the trigger yet? There might be other reasons you want to start Social Security. Maybe you want to use it as a bonus and you want to go travel and do things with it. Maybe you actually need the income and you're just postponing as long as possible so those payments go up higher. But now you're draining your portfolio while the market is going down and you haven't started Social Security yet. Is it worth examining that strategy and say, hey, could it be a possible better decision to go ahead and start a little bit earlier than I was thinking? You have to look at earnings restrictions. There are a lot of pieces involved in this, but does it make sense to start a little bit earlier than you had originally planned, therefore preserving the assets in your portfolio so when the market rebounds, you have those assets in there to rebound? Something worth considering. You have to look at this in the context of taxes, your overall retirement income plan. If you're collecting before your full retirement age, will there be earnings restrictions? Are you still working while collecting prior to full retirement age? All this needs to be looked at as part of a comprehensive plan, but it's an idea to consider, okay? And then number 4, our fourth strategy is our tried and true rebalancing strategy. So this strategy is what we do all the time when we are managing portfolios, and it's really just looking at your target versus actual. Very, very simple explanation here. We're going to have a portfolio of 50% equities, 50% fixed income, and equities, just another name for stocks, guys, and fixed income would be things like bonds. And let's just say we have $100,000 in the portfolio. So $50,000 in stocks, $50,000 in bonds, and that's at the beginning of the year. Well, we have this extreme market volatility. Now all of a sudden our portfolio is no longer 50-50, right? So our fixed income doesn't really fluctuate too much, but stocks fluctuate quite a bit. So we're going to say in the short 3 months of the first year, this portfolio had changed, and now only 40% of the portfolio is represented as equities, and 60% of the portfolio is represented as fixed income. So we have a target of 50-50, but our actual portfolio is 40-60. So how do we get back to our target? Well, we need to sell the assets or sell the asset category that has increased. A very simple explanation. It gets more detailed but behind the scenes here, but very simply, we need to sell what went up and buy what went down. Well, fixed income is overweighted by 10% in this example. Stocks are underweighted by 10%. So we need to take what is overweighted, we'll highlight this in green, 10%, and we need to sell that and purchase more stocks. Therefore, rebalancing the portfolio back to our original target of 50-50. Now, the other thing here is, guys, this happens both ways. 2021 was a great year for stocks. So in 2021, your portfolio is rebalanced again back to your target, selling stocks, buying fixed income. Extremely important strategy, and the main reason is to maintain your risk tolerance through time. Portfolios will generally become more risky over time without rebalancing back to your target. The other critical thing here is it takes the emotion out of investing completely. You're looking at the target, and within tolerances, you're going to stay disciplined. And if you're outside those tolerances, you are going to rebalance. Okay, very important strategy. Number 5, you need to keep an eye on risk. Maybe you need to reassess your risk tolerance. And I have kind of 4 steps here highlighted. Number 1, you can go to our website at mfswealth.com, and under the resources tab, you'll see what's called a Riskalyze link on our website. You can click Take a Risk Questionnaire, and I highly encourage you to take that risk questionnaire, and it will produce a risk number for you. So once that risk number is produced, It is your personal risk number. This is how much risk you can take, and it goes from 0 to 100. 100 being very risk tolerant, 0 being not risk tolerant at all. And then there's one more step that you have to do. You have to have your portfolio examined to make sure your current portfolio matches your risk number. So the other thing you can do is you can upload a recent statement securely on our website in the upper left-hand corner, secure portal. You can upload your statement, take that risk questionnaire, and we'll do that analysis for you, and we'll get back to you to let you know if you're within that risk tolerance. So that's it, guys. 5 quick, highly effective strategies to consider in a down market. I hope you enjoyed this brief coaching class. If you have any questions, please feel free to give us a call, or you can always email us at info@mfswealth.com. By the way, we'll put some links to some of the information I mentioned in this coaching class in the show notes. Just look at the bottom of more info and you'll see some of those links in the show notes. And if you have any questions, please feel free to give us a call and we'll talk soon.